Harsha Upadhyaya is now joining us. He's President and CIO Equity at Kotak Mahindra Asset Management Company. He's our market master of the day. Harsha, it's always a pleasure. Great to have you with us here on the program. Thanks very much. Just incredible, right? The outperformance, even on a day-on-day basis, which I reckon you will agree you could be on any particular day making up for previous outperformance or underperformance. But even if you stretch time frames, the U.S. market especially is going one way, and the market here continues to hold, if not gain. Your sense, Harsha, from here?
Good morning, Prashant. Clearly, I think India has been a bright spot in an otherwise challenged global economy, I would say. While we have done much better than most other markets in the recent past, the trend also continues. But we need to remember that we can't be immune to the kind of volatility that is likely to be there in the global equity markets. Having said that, I would say that the problems at Indian economy is much lesser as compared to what you would see globally. For example, the negative real interest rates across the globe is much higher than what we are witnessing in India. So to that extent, the interest hikes that would be required in Indian economy would be a lot lesser. So the growth impact is going to be a lot lesser. Even after a couple of interest rate hikes, our economy has been resilient in terms of growth. Whereas most other developed economies, whether you look at US or Europe, are already seeing very, very significant declines in growth rates. So for them, the problem is much severe. And for us, while we can't be immune to what's happening in the globe, I think we can do this volatility. So all the long-term investors who are using this as an opportunity to build their portfolios or to increase equity allocations will be doing well over the next 3 to 5 years.
Harsha, hi, good morning. Good to talk to you. Let's talk about some news based sectors. What's the approach at Kotak Mutual Fund for city gas players? And they did really well. They went through a period of sustained bull market, remain compounders. But over the last 2 years, there have been headwinds. How do you approach it? Because most of them remain monopolies, but there's cost pressure. Your approach?
Good morning, Anuj. As you rightly mentioned, I think these are near monopolies, and there is a lot of moat around these businesses. There is a steady improvement in growth that you would see over a period of time. But obviously, what has happened over the last 12-18 months in terms of price hikes has been difficult for some of these players to manage. While until now, they have managed their margins broadly, taking the consumer prices up. But the recent hike is going to leave some pain in the short term until they manage their overall cost dynamics. But we do believe that what we have seen in the 12-18 months in terms of gas prices may be behind us. And going forward, very unlikely that you will see this kind of price increases. Probably you can see gas prices peaking out as well. So given that context and the fact that these are near monopolies, we continue to hold a little bit of position in city gas distribution at this point of time. Not a very large exposure, but we do want to be present in this segment. And as gas prices come off, we would like to review our position to increase.
But may go up before they come down, Harsha, because of what's happening in Europe. Global gas prices, that is. Harsha, in terms of things that you are looking at in a constructive way, because you're still getting money as a fund and the industry is getting money. So where are you deploying that? Where are you seeing opportunities, outsized moves which perhaps are unwarranted, where, you wait out this period and you were in for some outsized gains? Which are those areas according to you?
In the last couple of months, we have increased our exposure to banking and financials. Within banking and financial, it's been mostly large banks because that's where we believe, while on one side you are seeing credit growth picking up, you also won't have the pain of cost of funds going up because there are reasonably strong CASA ratios across the board. Another pocket where we have been adding to has been autos, more particularly in the passenger vehicles, while we have some exposure to two-wheelers and commercial vehicles. But we do believe that passenger vehicle segment is likely to see very, very strong growth. And some of the headwinds that we had seen in the past, for example, the chip shortage or the commodity cost pressures, etc., also seem to be kind of normalizing. So we do believe that these two segments can be outperformers as we go ahead.
Okay. The market, by the way, just look at that. The Nifty's moved in the green once again. And It just tells you about the resilience of the Indian market, though the city gas stocks, of course, still remain down, which is very interesting. What's doing well apart from ONGC? Well, you have a couple of other names like HPCL doing well, NTPC is higher, a couple of other names. Reliance is clearly helping. I think that's a big factor in today's move. Just pull out the intraday chart of SBI. And that also has moved to high point of the day, so or the morning rather. So clearly, a lot of these stocks seeing buy on dips. Harsha, the other factor for this market has been domestic liquidity, and that remains as strong as ever, right? I mean, nothing has sort of shaken that belief of mutual fund investors. Do you think that is something which will keep our markets in good shape and may not lead to, even if we see the kind of global meltdown that we are seeing, may not lead to the kind of declines that we used to see, or we had become used to see earlier, say in 2007-8?
Domestic inflows are a big question for our markets in terms of reducing volatility, I would say. But again, even here, we need to remember that last quarter, that's July to September, we have seen a bit of moderation, nothing alarming. The SIP numbers still continue to be growing on a month-on-month basis. We are at record levels now. That continues to be the long-term trend, which also is more sticky. So I would say that quantum should continue giving a lot of support to the market. Whereas if you look at redemptions, they picked up a bit when Nifty hit levels of close to 18,000 last month. We have also seen lesser inflows into some of the existing funds, simply because I think at higher valuations, investors were a little cautious. So both these factors put together, despite the fact that SIP numbers are very, very strong and growing, we have seen moderate numbers overall for the flows into the mutual fund industry in the last quarter as compared to previous 12 months or so. So that remains a factor to watch out for, but I really do not see a situation where domestic flows will turn into negative, and that would put additional pressure to the market. That may not happen, but the kind of cushion that we were seeing for the entire October to June period, October of last year and June of this year, maybe a little bit is going down at this point of time.
Okay, yes, that clearly is helping on margin. What's your view now on large cap IT, Harsha? Because that is where we have seen the maximum pain. But of course, before that, we had seen this huge re-rating as well. And valuation-wise, we perhaps are still, compared to the averages, still at premium. So how do you approach this space now?
Yes, what you said is absolutely right. The valuations are still one standard deviation above the long-term averages for the IT sector. Whereas there are question marks in terms of how the growth momentum will unfold as we go ahead. We have seen a huge amount of liquidity tightening across markets, mostly the developed markets. And consequent to that, if there is any further deeper pain into financial markets and financial services companies, how that would feed into domestic IT services business is something that you have to keep evaluating. Because even today, roughly about 1/3 or slightly more than that is coming from BFSI segment. And if that segment is going to witness further pain because of what's happening in the global economy or otherwise, then how would the deal momentum would continue? What would happen to the kind of IT budgets in 2023, etc., would be a real question to answer. So to that extent, while on overall basis, you may see that this sector has underperformed quite sharply and has corrected a lot, but still it is one standard deviation above long-term average. So to that extent, we have remained cautious on the sector.
And since you mentioned autos, and I remember the big call that Nilesh also made 1 year back about the under ownership of autos and how that will play out. But now, Harsha, while we've seen the massive rally, again, if I go back and compare the valuation premium, if it's highest in any sector right now, it's for autos, at least on a 10-year period. So do you think the market assumes that maybe that's because the earnings have not picked up yet and they will now? Or is this just because, now it's becoming a bit of a overcrowded trade instead of being, the underweight trade earlier?
One is automobiles is a very, very cyclical industry. So to an extent, whenever you are seeing an inflection point, the valuations would obviously assume part of what is likely to happen and adjust themselves. So to that extent, I think the kind of uptick that we are likely to see in terms of growth or in terms of margins is already priced in. But we do believe that it can surprise on the upside, and it has longer legs to move further on. So to that extent, we continue to remain positive, but obviously, to an extent, the valuation comfort has reduced as compared to where we were a couple of quarters back.
Okay, so that's on the automobile space. One last question then, Harsha. What is, to your mind, the biggest risk for our market? Do you think we, despite the resilience, is there a risk that our market can go and break the recent lows, or are you reasonably certain that that may not happen?
See, it's always difficult to predict what would happen in the very short term, but definitely I think our market is going to be more resilient than the global market. I think that one can safely assume. But what levels, etc., it will be very difficult to say. Overall, I think whenever the dust settles in the global economy, I think India should get a higher proportion of global flows, as well as the domestic flow should also improve quite a bit. And we are also at the beginning of the new corporate profitability cycle. And I don't think the transient pressures that we have seen in terms of commodity costs, etc., would have any meaningful impact on the longer term trend of upcycle in corporate profitability. So overall, I think over the 3 to 5 year period, Indian market should definitely give reasonably strong returns. But what happens in the next 1 or 2 quarters, I don't think it's fair to predict on that.
Harsha, do you own any of, within financials, which of course you own, do you own any gold finance companies? Because that is one area which has done the worst, right? In terms of share price, pure share price performance. And if you have a view broadly on the space.
No, we have been more positive on banks rather than non-banking financial companies across the board. And the reason is simple. Whenever the interest rates start to harden in an economy, the banks have a better handle on cost of funds. And the NBFCs will be moving in line with what happens in the market in terms of cost of funds. So that's where we believe that in terms of spreads or in terms of margins, banks are in a better position to manage that as compared to NBFCs. And also the business is more diversified than any of the single vertical focused NBFCs as well.
No, absolutely. Got that. Auto components as a space, any particular areas? We had a recent new listing as well, Harsha. Many believe that, that may be a better route to play, and because it provides some diversification as well, rather than single stock OEMs. Auto comp perhaps is a better way to play the theme. Any thoughts on what do you like in that space? Which segments particularly?
We do have exposure to auto ancillaries across the board, depending on liquidity and the size of each of those businesses. We do have exposure across our funds, depending on the mandate. But clearly, I think one has to evaluate which are the markets that they are exposed to. While it may give you diversification, it may also give you additional risk. For example, if an auto ancillary is more focused on European market, for example, then that would bring in additional growth concerns. So you have to be careful in terms of choosing some of these auto ancillaries. But by and large, I think most of these companies which are focused on domestic auto business are likely to see better days going ahead.
Harsha, we'll leave it there today. Thanks a lot for joining us. Good talking to you as always. The market, by the way, has taken a bit of a turn on the downside, but it's very volatile. I mean, it's just really single ticks are worth 20-25 points on the Nifty. It's just all over the place, really. Every dip gets bought, and at higher level there is some selling. So I think it's going to keep us on our toes for better part of the day, I guess. We'll take a break. Up next, we'll connect with Rakesh Sharma, Executive Director at Bajaj Auto, to discuss their September auto sales. Also, we'll be joined by the CFO at Federal Bank, Mr. Venkat Raman Venkateswaran, to discuss their quarterly update and, of course, outlook going forward.